Hello, ladies and gentlemen. I hope you're fine wherever you are. I am the Acca tutor, Jay Mutimikulu. Okay, Jay for Jerry. All right. Welcome to this video segment where we are going to tackle our week 8 topics. And in this week 8, we're going to look at two international financial reporting standards, that is Ifrs 15 and 16. Okay, Ifrs 15 and Ifrs 16. All right, so we are pursuing our Acca financial reporting stud uh, pack. Okay, that's what we are um, just following. Okay, remember we are only left with just 2 more weeks study before we complete the syllabus, so that we start the revision phase. And if you feel like you want to join the revision phase, don't be scared, don't stay away, don't stay on the fence, just come in. We then have to engage you, all right? And the tutor is always online. I can teach you wherever you are, whether in Malaysia, in South Africa, UK, or even in the Australia. Okay, so I gonna teach you anytime, anyway. All right, so these are my numbers. When you feel like you need my coaching, that's my number, and this is my school email. Okay, the business email. Remember, this is an online school where coaching can be accessed anytime, anyway. All right. Now, when you're looking at IFRS 15, ladies and gentlemen, this is a standard on revenue from contracts with customers. All right, and IFRS 16 is about leases. All right, so we will be guided by the relevant Acca financial reporting start guide or syllabus, so that we do not touch on unnecessary materials. Remember, our coaching is exam targeted. All right, remember, these standards are examined in almost 3 Acca papers. Okay, the first one was financial reporting. All right, especially the IFRS 15 is something that is examined at financial accounting, that is formerly F3. Okay, okay, the F3 paper. All right, financial accounting. That's it was also examined there, and then you are also going to expect it. Both of these standards in the Acca paper SPR. Okay, so in the financial reporting paper, there are certain issues which are not going to be examined, all right? But we are only going to target those ones which we feel like they are relevant for our examination. All right, so the list is part of it is going to be tackled within the next video. Okay, I'm going to give a separate video for the leases. All right, so that students may find time to consummate, time to digest what they've learned in a particular topic. Okay, if we simply just bunch them in one video, it might end up like discouraging. Okay, so I don't want you to feel disappointed. All right, so ladies and gentlemen, this is the game. All right, we need to flow with the tide. We need to be committed. We need to just to be committed to the path. All right, remember, you need to have a vision to see yourself as an Acca member in the coming 2 years or even 1 year. All right, if you are so serious, you can actually finish all the remaining subjects within a year. So you just have to be regurgitate. I mean, to be reinvigorated. Okay, you just have to be focused on your goal, so that whatever impediment that comes on your way, you are able to succeed. Okay, you are able to overcome it. All right, so without much ado, ladies and gentlemen, I think we need to then get back to the business of the day. So we are starting with IFRS 15, so that we attack our mission. in a more effective manner. All right. Now, if it's 15, all right, what is it all about? Like I said, this is a standard on revenue from contracts with customers. So it follows a five-step model, right? It follows a five-step model. All right, so which means there are 5 steps which have to be satisfied before you, okay, or for you to recognize any income as revenue. All right, remember there are so many types of incomes, but for you to recognize a certain income as revenue or as sales, all right, you need to satisfy the 5-step model. So which means if at any step I mean you can't satisfy that particular step, then you cannot recognize that transaction as revenue. Okay, like for example, you at step number 2, you can see that you can't satisfy the requirements there, then you must stop recognizing that transaction as revenue. Okay, so the 5 steps are: step number 1, you need to identify the contract. Okay, we have studied contract law in our the Acca paper, corporate law, okay, or formerly F4. We tackled issues to do with the contract, and we learned that the contract could be express or implied. Sometimes it can be verbal, sometimes written. Okay, but the bottom line is it should be a contract. Okay, and we know of those issues to do with the offer and acceptance, those things. Okay, that's the contract we are talking about, ladies and gentlemen. There should be an offer, there should be an acceptance. Okay, and an offer is not an invitation. Oh man, all those things, we know them. All right, so that's contract we are talking about. It could be written or verbal. We'll talk much about this, or about how you are going to identify that this is a contract and this is not a contract. We're going to discuss the examples as well. All right, then step number 2 is you need to identify separate performance obligations within a contract. Oh man, and when we talk of performance obligation, okay, this is something that you need to satisfy to the customer. All right, that's your duty, that's the part, your responsibility. You need to ensure that you are going to meet. Then you need to identify each separate performance obligation within the contract. Remember, one transaction can actually expose you to more than one performance obligation. Okay, so you need to identify those obligations. All right, and like I said, we are going to delve much in the next coming minutes on the explanation of each and every one of these steps. Then step number 3 is determine the transaction price. You need to determine the transaction price, and you need also to know what the transaction price is. So by the end of this video, you will be able to understand what the transaction price is. Step number 4 is allocate the transaction price to the performance obligations in the contract. All right, you need to know how you are going to allocate those transaction prices, okay, to each of the performance obligations. Step number 5, you then have to recognize revenue, sometimes at a point in time or over time. Okay, so recognize revenue when or as a performance obligation is satisfied. All right, so let's move on. How do you identify a contract? That's the question which could be of interest. The contract does not have to be written. It can be verbal or implied. In order for Ifrs 15 to apply, the following must all be met. Must all be met. Okay, number 1, the parties to the contract have approved the contract and are committed to perform their respective obligation. So this is why I talked of the offer and acceptance issues. This should be, the offer should be distinguished from mere invitation. If somebody says, "Oh, please come to my shop, I want you to see what I'm selling," that's not an offer. Okay, you're just inviting people to come and see your wares. Okay, all right. So those are the things you need to then have to see and say, "Oh man, now this is now an offer, and this is just an invitation." Okay, so the parties to the contract have to approve the contract and be committed to perform their respective obligations. Somebody has to sell something, somebody has to pay. Okay? The entity can identify each part's rights regarding the goods or services to be transferred. Okay? So the items which are going to be transferred have to be identified. All right? And the obligations, for example, there should be a seller, there should be a buyer, and so forth. The entity can identify the payment terms for the goods or services to be transferred. The payment terms have also to be agreed. Are you going to pay within 30 days? Are you going to pay within a day? Okay? Or are there some discounts and so forth? All right? What are the terms of payment? All right? And so forth. The contract is commercial substance. Sometimes there won't be necessity to worry about it when by the end of the day it's something that is so trivial. Okay, something that is so insignificant. Okay, so the aspect of materiality, there should be some commercial sense. Otherwise, we shouldn't worry about it anyway. Okay. Then lastly, it is probable that the entity will collect the consideration to which it will be entitled in exchange for the goods or services that will be transferred to the customer. If by the end of the day we are not going to expect any payment, then why should we consider it a sale? Why should we consider it a sale contract? Okay, because by the end of the day, even if all those things have been satisfied, but we know this guy is not going to pay us any money. Okay, we're not going to expect any money from this guy. Why then shall we say it was a sale contract? There was no sale. Okay, there was no sales, my brother. There was no sales contract. So we are not going to recognize and revenue. Okay, because we know. We just know this guy has been declared bankrupt, and we have given them the goods. So technically, we know in our mind that we are just gambling for a zero. So in that case, we are not going to recognize any revenue because there is no sales contract. We know that we are not going to receive any payment for the goods which we have transferred. All right, I think we need to look into this part on the step number 2 to see. Okay. Step number 2 is saying identifying the performance obligation. Remember, we could have identified that the contract exists. Okay, all the criteria has been met. We expect to be paid and so forth, and the contract has been written or implied or verbal. All right, and the rights to when it comes to the performance, we know that we have identified each part's rights regarding the goods or services to be transferred, and the entities can identify the payment terms for the goods or services to be transferred, and the contract has commercial substance. We have satisfied all these. All right, but now we then have to go a step further and say, what are our performance obligations? Okay, how are we going to proceed? What is our duty in this particular contract? Okay, what are our tasks to ensure that the contract can be tackled? All right, so performance obligations are the promises to transfer distinct goods or services to a customer. All right. So what are the promises we have made to ensure that we are going to give Mr. So and so these quantities? Okay. And we need to understand one thing. The word obligation is actually the bedrock of a contract. Okay, like when we discussed about the offer and acceptance, remember when you offer yourself to commit to something, you are obliging yourself to do something. All right, so if you do not do that thing, then you the contract will be enforced against you. Okay, so performance obligations are promises. In the business world, we use the word promise, but doesn't mean that a promise, this type of promise, is not going to be enforced at law. It is going to be enforced. All right, but now the word promise is actually something palatable in the business sense. We don't have to use those highly legal jargon. Okay, so we end up like intimidating people to do business. So the word promise is actually a befitting one. So performance obligations are promises to transfer distinct goods or services to a customer. If the goods or services that have um, agreed to be exchanged under the contract are distinct or could be sold alone, then they should be accounted for separately. If a series of goods or services are substantially the same, they are treated as a single performance obligation. Okay, sometimes you discover you can't actually sell something alone. You just have to sell it in a bundle. Okay, so in that case, uh, the transaction is going to be considered a single performance obligation. Okay, because technically you can't sell those items as standalone or distinct goods. They need to be bundled for them to be sold. All right. Now let's look at that illustration. DevTech is a computer business that primarily sells computer hardware as well as selling computers. It also supplies and installs the software to its customers and provides a technical support package over a number of years. The business commonly sells the supply and installation and technical support in a combined goods and services contract. The combined goods and services contract has two separate performance obligations, which would need to be separated out and recognized separately. Okay, so we are seeing that this company sells computers as well as some services, like for example, they give some technical support if they sell you something. So we can see that there is a fix and supply uh, that is they sell goods and install, all right, and install the goods, and then they then offer some like technical support throughout the period. Let's say, for example, for the next 2 years, they will be actually giving you. So the technical support is another obligation. So we are having two obligations. Okay, so the installation of software would be recognized once complete, and the provision of technical support over the period. So we are saying, like here now, we are almost at step number 5, where we are saying now, for us then to recognize the revenue of these guys, one of the um, one of the obligation uh, is going to have its revenue recognized uh, at a particular point, at a point in time. Okay, point in time. That is when we finish the installation, I mean the supply and installation of this uh, software, we then have to recognize the revenue component of that. And then for this technical support, you will see that the revenue is going to be recognized over time. Why is it over time? Because we are not going to satisfy the obligation on a particular day. Okay, we will be having a series of recognition phases. Okay, for example, we will recognize for year one at the end of year one. All right, so and then at the end of year two we recognize another. So in this case, we are having the issues of deferred income. Deferred income comes into play. And when you're talking of deferred income, we are talking of amortization of income. The income will be recognized in an amortized fashion. Okay, that is it, ladies and gentlemen. That's the idea. So you need to identify your performance obligation. Okay. And in this case, the performance obligations have been identified as number one, uh, the supply and install of fixed supply uh, as performance obligation number one, and then the technical support, which then follows as obligation number two, and these have to have their separate I mean recognition criteria. Okay, let's move on. Step number three, you need to determine the transaction price. The transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer. All right, so that's the consideration you are going to expect to receive by the end of the day. Amounts collected on behalf of third parties such as sales tax are excluded. We do not include sales tax in this type of consideration. Okay, so the net sales tax figure is the one we are going to consider. Okay, also you will discover as we proceed that even in instances where we have got excuse me, issues to do with commission of agents, we'll talk about this. Okay, only the commission part is the revenue. The other component or the other amount as a result of a sale, if it was collected on behalf of the principal, then that's not the agent's money. That's not the agent's revenue. It is the principal's money. Okay, so it is not going to be included in the revenue figures of the agent's books. Remember, the agents would be having their own companies. It will be a separate company that is selling on behalf of the principal. They are selling goods on behalf of principals. So in that case, the agents in their records, in their books, they only have to recognize commission, the commission they get as their revenue. The remainder will be a payable. It's something that is going to be transferred to a third party. Are we together? All right, we have actually touched some of the things there. Then the consideration promised in a contract with the customer may include fixed amounts, variable amounts, or both. When determining the transaction price, an entity shall consider the effects of all of the following. Okay, variable consideration, the existence of a significant financing component in the contract, non-cash consideration, consideration payable to a customer. Perhaps we need to then understand what we mean by variable consideration and the rest of the other items there. All right, so let's proceed here. The transaction price would reflect the customer's probability weighted estimate of variable consideration, including reasonable estimates of contingent amounts, in addition to the effect of the customer's credit risk and the time value of money if material. Variable contingent amounts are only included where it is highly probable that there will not be a reversal of revenue when any uncertain associate when any uncertainty associated with the variable consideration is resolved. Examples of where a variable consideration can arise include discounts, rebates, refunds, price concessions, credits, and penalties. Okay, in a nutshell, we are simply saying if we are looking at variable consideration, we are looking at a situation where a customer has a lot of options to effect the transaction. Okay, for example, let's say if a customer buys quantities of 500 boxes, he has no discount. Okay, and then if he buys 501 to 999 boxes, he's entitled to 1% discount, and then more than 1000. Okay, let me just say up to 1000, 501 up to 1000, he has not. Then more than 1000, he's entitled to 5%. Then we can say the customer has many options to offer us variable consideration. Suppose when they come on the first day, they were only able to buy 500 boxes. So when we recognize revenue, our transaction price was actually based on 500, and in that case, we only recognize, let's say, 2 million. However, during the course of the year, they came again and then they added more boxes, and now they were now able to claim the discount. So you can see that the revenue now is now variable. Okay, why is it variable? Because there is now a probability that they can as well reach to a 5% discount. All right. So we then have to use the weighted probability or the probability theory to say, okay, maybe there is an 80% chance that they are going to meet the 5% threshold, or there is a 2% chance that they are going to meet the 1% threshold, and so forth. So when we are now using the issues to do with probability, then we can now say that there is an aspect of variable consideration. Sometimes we might as well say if a customer, let's say, procures equipment for mining, because our country is a mining rich country. So if a company is importing heavy duty mining equipment, then they are likely to be given some rebates. Okay, so those rebates are actually going to lead to the scenario of variable consideration. Okay, so in the business sense, we are simply saying that a rebate will act like a discount. A rebate is like a discount. All right. The only difference between the two is that a discount is actually enjoyed at the time when one is getting involved with the sale, okay, or when he is within the transaction period, or when he is entering into the transaction. However, the rebate is after the transaction. All right, like for example, you need to first satisfy that you have bought 1000 boxes, all right, and you paid. Then when you pay the supplier might give you as an incentive to say, okay, fine, you are a good customer, you have paid our money, all right, we are going to return to you 500,000 bucks. All right, so in that case, when the supplier is recognizing the revenue, he then has to deduct the rebate that has been given to the customer. Okay, so that one fits within the category of variable consideration, because if the customer has the ability of meeting that threshold, then we need to expect a variable consideration. All right, we need to expect a non-static consideration, which is, or a non-fixed consideration, which is a variable one. Why? Because there's a possibility or probability that this customer might satisfy the requirement for the rebate, and by the end of the day, we need then to adjust our consideration. All right, I think we need to look into this particular example and see if we can illustrate this point home. Example on determining the transaction price, Bindura IT Co. Bindura IT Co supplies laptop computers to large businesses. On 1 July 2025, Bindura IT Co entered into a contract with Halex Co, under which Halex Co was to purchase laptops at $500 per unit. The contract states that if Halex Co purchases more than 500 laptops in a year, the price per unit is reduced retrospectively to $450 per unit. Bindura IT Co's year end is 3rd June. A. As at 3rd September 2025, Halex Co had bought 70 laptops from Bindura IT Co. Bindura IT Co therefore estimated that Halex Co's purchases would not exceed 500 in the year to 30 June 20x6, and Halex Co would therefore not be entitled to volume discount. They were not entitled, okay, as at that particular time. Then B, during the quarter ended 31 December 2025, Halex Co expanded rapidly as a result of a substantial acquisition and purchased an additional 250 laptops from Bindura IT Co. Bindura IT Co then estimated that Halex Co's purchases would exceed the threshold for the volume discount in the year ended 30 June 20x6. Now, required. Calculate the revenue Bindura IT Co would recognize in A. Quarter ended 30 September 20x5, B. Quarter ended 31 December 20x5. Okay, this is the question, ladies and gentlemen, and we need then to have the focus of determining the transaction price at the core. All right, so when you are faced with such a weighty problem in an examination, you need then to stand on your principle. All right, so we have been told that we need to determine the revenue. These guys should recognize first at the quarter ended 30 September 20x5. Now, at the end of this quarter, we need to determine the circumstances which build up towards the end of that quarter. Okay, we then have to analyze those circumstances to see if it was possible that this customer could reach the threshold required for us to give them a discount. Okay, I mean to charge them a price with that has been discounted. All right, because remember the unit price of a laptop is $500. However, if they meet a certain threshold, okay, like for example, if they purchase more than 500 laptops in a year, then we can as well give them a discounted price or a discount. All right, and you must also know that the examiner is saying in a year. If you purchase in a year, which means your cumulative purchases should at least exceed 500. So at any particular point in the year, if your purchase cumulatively exceeds 500, then you are required to be given a discount. So which means all the initial purchases which you bought when under the circumstances when you were not entitled to a discount, would then have to be precluded, okay, or would be overtaken by the new developments. All right. So by the end of the quarter ended 3rd September 20x5, you can see that Halleck's core could not show evidence that they will exceed the 500 laptops threshold. So in that case, we are only going to recognize the revenue as 70 laptops multiplied by the full figure of $500. And in this case, we are going to recognize 35,000. Okay, let me confirm with my calculator to see if I've done it correctly. Hey, calculator, where are you? Okay, the 70 multiplied by 500 and 3 zeros, yes, 35,000. Okay, so at the end of this quarter, we need to recognize revenue of 35,000. However, you can see now that at part B, the circumstances changed. All right, there's been a substantial acquisition, and this customer came to the shop and purchased an additional 250 laptops. So obviously, in this case now, we are now motivated, okay, because if you add these laptops, they are now about 320 laptops now, which they've bought, because an additional 250 from 70, that's almost about 320. Okay, there are now 320 laptops which have been bought. So there is a high chance that these guys can exceed, the 500 threshold, 500 laptops threshold. So in this case now, our revenue figure has to be adjusted, has to incorporate the discount. All right, there is now a probability that they may exceed the threshold. All right, so Bindra IT Code then estimated that Halleck's Core's purchases would exceed the threshold for the volume discount in the year to 30 June 20x6. So even if they haven't exceeded for now, all right, but there is a chance now. So this is where we said when it comes to variable considerations, we then have to use the probability weighted estimate. All right, so in this case, the estimate has been based on probabilities. Okay, it has been based on probabilities. So how are we going then to recognize the revenue? Right, so the revenue now is now going to be the revenue for the quarter ended 31 December 2025. Okay, this time they bought 250. Okay, so it's 250 laptops. Multiply now by 450. Okay. Let me use my calculator. That's 250 multiplied by 450. That's 112,500. Okay, but we know that since there is now chance that the threshold can be met, and we know that the sales are for the year, all right, so there is a chance that within this year they might exceed the 500. This is why we have levied their price at 450. Okay, so we say 250 laptops by 450 and we get 112,500. However, they had bought initially the 70 laptops, okay, at a price which was more than the discount level. So the difference, we had charged them 500, okay, instead of 450. So the difference is $50. This has to reduce our revenue. Why? Because it is a discount. Then these guys are entitled to a discount. But remember, even if we recognize this particular revenue, we then have to consider it as a variable consideration because they might as well fail to meet the 500 at the end of the year. Okay, so remember, the year end of this company is 30 June. So at 30 June 2026, they might fail. So remember, we expect that at 30 June, they would have exceeded the 500 threshold because at the almost half year, at 6 months into the year, they had already purchased 320 laptops. So by 30 June next year, obviously, they would have purchased more than 500. Okay, simple arithmetic would tell you that there is a high chance these guys are going to exceed the threshold. So far, here we are saying 70 multiplied by 50, that's 3,500. So this one has to be deducted so far because we had charged these guys a full price, not knowing that circumstances will change. All right, so that's 112,500 minus 3,500, and the total revenue for the quarter ended 31 December 2025 should be $109,000. Okay, that is it, ladies and gentlemen, on variable consideration. It is variable in the sense that circumstances might change that would warrant us to reverse the position. Okay, we might reverse the position and say, oh, we had levied you 450, hoping that we were going to reach the threshold by 30 June. However, you failed to reach the threshold, so therefore we are now reverting back to the original price of 500 USD. Are we together, ladies and gentlemen? Good. Let us move. Now, let's talk about the financing aspect, the financing. Remember, sometimes this revenue, which you need to recognize, the revenue would also be affected by the issues to do with financing. Okay, when a sales transaction involves cash, when a sales transaction involves cash only, it is deemed that the customer will only enjoy the receipt of goods or services. So when you sell an item on cash, therefore the person or the buyer is going to enjoy the goods or services offered. That's the type of enjoyment which they are going to enjoy. Okay. However, when the transaction involves credit now, if you sell goods on credit, then the customer is usually said to enjoy both the good or service and a financing service or benefit. All right. So in this case, if it is a credit, okay, credit transaction, therefore they are enjoying the ordinary goods or services as well as the credit facility. The credit facility is what we call the financing component. Okay, they're being financed because they're enjoying the goods today, but they're going to pay tomorrow or sometime later. So if the credit facility is so significant that they is going to warrant more time, then the time value of money aspect comes into play. The discount factors, they come into play. All right. So in this case, okay, in this case, the value of the goods is equal to the present value of future cash flows, and the difference between this amount and the transaction price will be the value of the services offered, the financing element. Okay, so if the credit is such a significant issue, then the goods, the price of the goods which this guy is going to enjoy in a credit transaction, the price of the goods are going to be in present value terms, which means that suppose you give people or a customer goods worth 8 million. All right, that was the transaction price. The transaction price was 8 million. However, these guys are not going to pay you overnight. Okay, they are not going to pay you tomorrow. All right, they are going to pay you maybe after a year or two. Okay, so the 8 million has to be discounted because you're going to receive this 8 million in 2 years or in 1 year. All right, so you need to discount it to present value terms. So you discover that the PV would be something like 70. The present value terms of this man will be 70 in 2 years. Okay, so the present value of 80 million in 2 years is actually 70 million today. Okay, so you have to value the goods at 70, and then the balancing figure of 10 million becomes the finance income. Okay, this, or the interest income. Okay, the 10 million will be the interest income. All right, so that's how you are going to determine the transaction price. Remember, we are still at the transaction price level. All right, so the transaction price in this case, the 8 million has to be shared between the price of the goods, which is 70 million, and the interest income. So which means in your revenue, if you recognize the whole 8 million as revenue, you are going to be wrong. The auditors are going to find you wrong. Okay? The revenue there is 70 million. The 10 million is other income. The 10 million is other income. Are we together? The 10 million is the balancing figure. Okay, remember the 70 million has been found by discounting. Okay, has been found by discounting. So it's a present value. That's the amount you're going to recognize as revenue. The remaining part is the financing component, the financing element. You have financed the customer, so he has to pay you. You have financed the customer, he has to pay you as interest income. But this interest is going to be received in 2 years or over 2 years. So you can see as well that the recognition criteria for the two incomes, okay, the revenue is going to be recognized at a point in time. Excuse me. Okay, all right. I was saying the recognition criteria of the two items here, the present value of the price of the goods and the finance income are going to be different. The present value of the goods, okay, this price, the 70 million price, is going to be recognized at a point in time, that is immediately. Okay, the goods are going to be recognized. The value of the goods is going to be recognized immediately. Okay, whereas this credit facility or service, remember the credit facility is actually a financing service, is going to be recognized over time. Why is it so? The issue is about the performance obligation. All right, when a customer comes, we give them the goods, right? So because we gave them the goods and they are in control of the goods, we have satisfied the performance obligation on our part. Okay, we have satisfied the performance obligation. However, the finance income is going to be recovered over the 2-year period. If this customer is going to pay us in 2 years, or is entitled to a credit facility over 2 years, therefore we are going to recognize the income over those 2 years. Remember the aspect of amortizing. Now, the question might come and say, shall we recognize revenue immediately when this customer is going to pay us the credit as a whole in 2 years? Like for example, the 70 million we are talking about here is going to be paid over 2 years. So shall we have to recognize the revenue immediately or over 2 years? Remember, we are using the matching concept. Okay, the matching concept. So the performance has been satisfied immediately. All right. So obviously, even if these guys are going to pay us in matching concept or the Acca concept, we are simply saying that the revenue has to be matched against the relevant expenses. All right. So we do not have to consider whether the cash has been paid for the expense or for the revenue or not. Okay, we have earned the revenue. This is why we are recognizing it, because when we sold, we have done our part. So we are now entitled to the consideration. So this consideration, we have to recognize it immediately. However, when it comes now to the income for the finance income, all right, this one now, we cannot recognize the whole 10 million today. Why? Because we are going to satisfy the credit service to the customer over the 2 years. So this is the cost to the customer, which he is going to incur over the next 2 years. However, when it comes to the enjoyment of the goods, he's going to enjoy them today. So this is why we are also going to charge him today. But when it comes to the aspect of the finance facility, this facility is going to be enjoyed over 2 years. All right. But when it comes to the sale of goods, he's going to have control of the goods today. So therefore, we are going to recognize the revenue today. Matching. Okay, that's the issue of matching. Then the aspects of Acca, we are simply saying that regardless of the fact that they haven't paid us the money, but we have actually earned something. All right, we have earned something. So we do not have to worry whether we are paid or not, as long as it is enforceable that we are going to receive our money. The contract is there. Okay, don't worry, that's it. All right, for now, just photocopy it as it is. So it is worth to note that the financing benefit should be considered significant for the consideration to be discounted, and the following are potential indicators of significance. Number one, a difference between the amount of promised consideration and the cash selling price of the promised goods or services. So when you do your discounting, it should actually have some there should be some significance. This figure of finance income or the finance cost, I mean, this is income, not cost, actually. Finance income. The finance income component should be a significant figure. All right. So the difference between this price, the promised consideration, and the cash selling price. Okay, the cash selling price was 80 million. Right, and then okay, Okay, okay. No, this is the credit price, right? And then maybe if the cash price was, say, 73 million, this was cash, this was credit, you can see that 7 million is actually a very significant figure. So if the difference between the amount of promised consideration and the cash selling price of the promised goods or services is so significant, then we can simply infer that there is a significant, the financing facility or financing benefit is actually significant. Then, a significant length of time between the transfer of goods or services to the customer and the payment date. So sometimes if we transfer the goods today and then we are going to receive payment in 2 years or 3 years or even 1 year, then that's a significant financing facility to somebody. Okay, they would have spinned or spun the goods. Okay, they would have spun the goods and make some money, right? So those are the two indicators. If the difference between the cash price and the credit price is so big, then the financing benefit would also be big, and then you need then to follow the present value of cash flows method in recognizing your revenue. All right. So why is this part important? This part is important because you might overstate revenue if you do not follow the part wisely. Okay, you might end up overstating the whole revenue. Okay, so if the credit facility, if the credit price of the goods or the promised consideration is so big than the cash price, then you can as well see that that benefit exists. Also, in this case, as you can see that the credit price was 80 million. All right, the credit price was 80 million, and then the hypothetical finance income was 10 million, as well as the present value was 70 million. You can as well see that if we had recognized the whole 80 million as revenue, would have overstated revenue by such a significant figure. The required transaction or the required entry was that revenue was supposed to be 70 million and the other income 10 million. So if we had skipped this part, then it means that the revenue would be overstated by almost 10 million. Okay, somebody might be asking, so what is the required double entry in recognizing this type of revenue? How do we recognize it? Okay, so it means that we need to debit, okay, we debit receivables, okay, it's 8, okay, no doubt, the receivable is 80 million, okay, but then we need to credit, okay, we credit, this time we've got two credits. The first credit is the sales should be 70 million, and the finance income, if it was supposed to be paid within a year, then the whole finance income goes here. Okay, so finance income 10 million. So we are having two credits. The sales are going to be on the online, and then the finance income on its own line. All right, I think we'll be having an example. Don't worry, there should be an example. Yes, let's work out this. You can pause the video and try this on your own. All right. VBX Co made a large sale of goods on 1 July 2008, which was also the date of delivery. All right, so the date of transaction is 1 July 20x8, and the goods were delivered on that particular day. Under the terms of the agreement, VBX Co. will receive payment of 8 million on 30 June 20x9. So 1 year later, all right? Currently, VBX Co. has recorded 4 million in revenue and trade receivables. The directors intend to record the remaining 4 million revenue in the year ended 31 December 2009. So, wow, these guys have recorded 4 million in the year ended 31 December 20x8. So they recorded how much? 4 million revenue. And the receivable, a common receivable, was also been recorded. The cost of this sale have been accounted for correctly in the financial statements for the year ended 31 December 2008. Right? But I want you to see something. If you are going to receive a payment 1 year later, it means this is a credit transaction. And if it is a credit transaction, then there are two things involved. Okay? There is the 8 million, the transaction price is 8 million, and this has got two components. Okay? There is the price of the goods as well as the financing service. So we need to allocate this 8 million. The total of 8 million should be allocated between the two. All right? So we say that the price of the goods should be the PV of future cash flows. The PV, which is equal to, we are told that the cost of capital for this carbon is 8%, which has got a corresponding discount factor of 0.9259. And if you do not know how to calculate these discount factors, please refer to our previous videos. I think from week number 6, week 7, and so forth, we were illustrating on how we calculate discount factors. All right, or simply become a student. Those are the numbers we help you to navigate this notorious Acca financial reporting territory. Okay, will help you to navigate the terrain. Now, the PV of 8 million at 80% is how much? Okay, that's we get the PV as 8 million multiplied by the discount factor of 0.9259. And what do we get? Let us use our calculators. That's 7.4 0.72. Okay, 7.4072. Now, I said the financing element is just the balancing figure. Okay, yes, it's 7.4072. So the balancing figure. So that's for us to get the financing service, we just say 8 million minus 7.4072. That's 0.5. 0.5928. Okay, I'm sorry, I'm writing the solutions on the question because the moment I try to go to the next page, sometimes you guys won't be following nicely. All right, so please bear with me there. I'll try to ensure that you guys get all the satisfaction you need. Now, we are then told that these guys had recognized 4 million when they were supposed to have recognized 7.4 million of revenue. Maybe the directors were conservative, we don't know, but that revenue was understated, and that could actually impact on the requirements of certain shareholders. They might feel like you are shortchanging us. Okay, your disclosures are not adequate. All right, the profitability would be affected as well, and maybe their payments for dividends, their dividend requirements would also be affected. So that type of reporting is not required. Okay, so the revenue was understated. By how much now? Okay, so what was supposed to be the correct revenue entry? And that is what we then have to. So allow me, ladies and gentlemen, to go to the next page and see what we can do. Okay, so first of all, let us start with what they did. Okay, what they did. They debited receivables, how much? Only 4 million. And credited revenue, 4 million. All right, for this part of the year. All right, maybe they say that, okay, from 30 June to 31 December, that was only 6 months, so we just have to record revenue proportionately. I don't know. Okay. All right, so you can see that the receivables were understated. The revenue was also understated by a certain amount. Okay, so but what should they, what, so this is what they did. What should they have done? All right, okay, they should have debited, all right, receivables by how much? 7.4072. 4072, and credited sales 7.4072. So what is the required adjustment? Required adjustment. The required adjustment, ladies and gentlemen, depends on our understanding, right? Since they recognize this revenue of, receivable of 4 million and revenue of 4 million, the required adjustment should be the difference between this, the difference between this and this. Okay, the difference between what they did and what they should have done. So in this case, since the revenue is understated, because remember, revenue was supposed to be 7.2, but it was 4 million, right? So the difference is just 3 million 0.4072. So we simply have to debit the receivables again to increase the receivables by the difference, 3.4072, and credit revenue with the same figure. Even if the amount was going to be paid after 10 years, the revenue has to be recorded in the year in which it was earned. Okay, so that was that. And then what about the financing element? The financing cost, we need to worry about the financing cost. And the financing cost, double entry, okay, financing income, it's not a cost, please bear with me. Okay, the financing income. The financing income, like I said, is going to be received over time and in future, right? So it is also a receivable. So we're going to debit receivables. So it is increasing the receivable. Okay, and we determine that it was how much? From our computation, this one, 0.5928. So finance income. We credit it. This is the credit with the same amount, 5928. But this is a wrong entry. Why? Because the finance service or the financing service is going to be given over time. All right. So we need to prorate it. We need to prorate it. All right. Now, how do we prorate? Remember, the date of the transaction was 1 July 2008, and the year end is 31 December 2008. Okay. All right, 31 July. 01 July 20x8 to 31 December. So 31 December 20x8. So this was 6 months. So perhaps this had motivated these directors to recognize, half. All right, since the other part, the amount was going to be received by 3rd June in 2009. So maybe that's where the confusion came from. All right, but like I said, revenue is recognized immediately. All right. So, but the finance income then has to be prorated. All right. So, the finance income for 2008 should be the half, not the full amount of 0.5928. We only have to recognize half. So this means that we're going to say we debit, okay, we debit the receivable, receivables. Remember, this is the receivable. So debit receivables. This is the correct end, ladies and gentlemen. Okay, the correct entry. So that's 0.5928 multiplied by 6 months. Okay, that's 6 months only, and that's 0.2964. That's the appropriate amount of receivables that should have been recognized for this finance income, and then the finance income itself, the finance income is going to be credited with 0.2964. This is for the year ended 31 December 20x8. Okay, so our total receivables should be this amount, that is for 2008, this amount, all right, and don't worry. And this amount. Okay, so that's the total receivable, should be 7.4072 plus 0.29. Let me just take the figure from the calculator. I'm thinking it's 2 there, yes, 0.2964. Let us add these two and see. 7.4072 plus 0.2964. Okay, That's 0, sorry, that's 7, 7.7036. And if we separate this amount from 8 million, remember 8 million is the total contract price, the 8 million. So if we subtract that 7 from 8 million, the 7.7036 minus 8 million, we get the remaining receivable. I mean, the remaining finance income in the 2009. That has to be recognized in 2009. All right. This has to be recognized in 2009 as our outstanding amount, outstanding income. Okay. Why? Because we have prorated. Okay. We have prorated, but you can see that there are different figures. There are similar figures and equal incomes. The one has been recognized in the year ended 2008, and the other one is going to be recognized in the appropriate year, that is in 2009. Okay, well, I hope we are together. Let us try another example. Maybe with this example you might see the clear picture again. Terraco enters into a contract with the customer to supply housing furniture on 30 September 2023. Control of the furniture transfers to the customer on that date. The price stated in the contract is 750,000 and is due for payment on 30 September 20x5. How many years are we talking about here? That is 2 years. All right, from 30 September to another 30 September 2005. 2003 to 2005, to me it's like 2 years. All right, that's 2 years. Market rates of interest available to this particular customer are 7.